All right, welcome, ladies and gentlemen, to the MACROACE live stream with your host, Tony. Also, I'm the head financial analyst at FinancialJuice. So we don't have a super behemoth big report to look at like we did last week with non-farm payrolls, but we have the Canadian employment data, okay? And this is going to be quite important for the Bank of Canada and what they do with their interest rate decision. What they already win in the future, whether or not they continue to decide to maybe hike rates like they did this week with a surprise 25 base point hike when the market was expecting them to remain unchanged. So what we're going to go through is what are the expectations for Canadian employment? What does it mean? How does it affect the market? And what is the sentiment surrounding the Canadian employment data so far? So don't forget to like the video, subscribe to the channel, get the word out there to your fellow traders and friends if you found this information useful before. So what is the Canadian employment data? So it measures the change in new jobs being added to the economy. And that includes both full-time and part-time workers. Now it's more or less, it's the same as the non-farm payrolls data. Again, it's the net amount of jobs being added to the economy. Gives you an overall picture of how healthy the jobs market is. Then you have the unemployment rate, which measures the number of unemployed as percentage. Again, similarly to the non-farm payrolls report, going to people and asking households about their employment situation. Okay. And then how does it affect the markets? Quite simply, if the data is very strong or stronger than expected, then you would expect an uptick in the Canadian dollar. One of the reasons why that would be is the confidence in the Canadian economy that jobs are being added, and that would in turn boost productivity and growth. Two, there's also the expectation that the Bank of Canada will see that the jobs market may be overheating, and that there is a need to raise interest rates, and in turn that would bring up the value of the Canadian dollar overall. Then in the bond market, okay, so the bond market, it's the same sort of scenario. If we're talking about bond yields, when you have a stronger than expected report, bond yields tend to go higher because again that's in the anticipation that the central bank will take more action to raise rates to bring down to try and cool the economy as best as they can. Or the flip side is that when the economy usually does well, that bond yields naturally go up because you have traders that will maybe during a period of no growth or period of economic instability, they're unsure about what's going on in the economy, hence are in bonds in the first place, which is government backed and secured way to park the money safely. If the economy is starting to do well and that there is confidence that is put back into the economy, then traders will then flock to the stock market instead because they're expecting better returns from the stock market rather than investing in the bond market. So what happens is that the government will then raise the yield on those bonds and then decrease the price in order to attract people to buy into the government's debt in return for a rate of interest. So that's how the bond market generally reacts. And we've seen that recently, that the main cause of why the bond market has reacted in the way that it has before, with bond yields going higher on better than expected data, is in the anticipation of the central bank raising interest rates further for longer, and which in turn boosts of course, whenever you boost the interest rate secured overnight rate for the from the Bank of Canada, that also increases the yield on the other bonds as well. So that's the bond market. For the stock market, I've more or less talked about it. But when you do get in a normal environment where there's no hiking, there's no rate cut scenario, there's just normal trading environments, and sentiment isn't too crazy, then usually with a very strong jobs report, stock market appreciates in value. Why? Again, it goes back to the currency and the reason why the currency sees an appreciation. is because that the labor market is strong, the economy is seeing a pickup, and if there are more jobs being added, there's a likelihood of consumer spending to increase further as well, which will increase profits for those big businesses or for those businesses in general. On the flip side, though, what we've seen recently is that when you do get a strong jobs report during a tightening phase of a central bank, that is generally not good, because whenever you raise interest rates, you're raising borrowing costs for those businesses and also consumers too. And then also anyone taking out a mortgage, of course, with consumers, or taking out a loan in general, will have to pay back more, and that will then naturally put off people and businesses from taking out a loan or having to pay back more on their loan because of the high rate of interest. So that's the reason why the stock market doesn't see an appreciation when you do get better than expected jobs data during a hiking cycle. In the US, there might be a bit of a change, like we kind of discussed with non-farm payrolls figure, as to how good data might still be good data, and it might not all be bad data for the stock market. But we've seen recently for the Canadian market that it has been negative when you have had stronger than expected jobs, particularly when you have surprises by the central bank that are delivered that makes traders more cautious, hence increases volatility within the market and caution. So the previous report then, so the overall, we can see that a lot of jobs, there's a solid amount of jobs being added, albeit not being too crazy over the moon in the three figures, or let's say, not in the six figures, if we're not going off of how this is represented. So wholesale retail trade saw plus 24k jobs being added, warehousing 17k, information, culture, recreation 16, educational services 15, and the only area where there were less jobs that were added compared to the prior month was in business, building, and other support services. So what does this tell us? That the services side of the economy, within Canada, is still seeing solid job gains, where jobs are being, with solid job gains, as in jobs are still being added in those sectors, and that in turn is something that the other central banks have been wary of the services side of inflation. Of course, if there is a need, or if there, particularly with, of course, with summer, and there are more people taking holidays, using those services and getting those goods that are provided by those services, then of course that means that there could be an increase in inflation if that isn't controlled. So what's the best way to do that? It's to raise rates instead, enough to kind of stop businesses from opening up more jobs, or creating new jobs, and then filling them up with potential customers for the future. So part-time employment was the main driver of the report. It increased by 1.3%, which was the first notable increase since October 2022. Now, of course, part-time jobs, yes, that is quite useful to understand that people are taking on roles, but one area that you don't want to see huge gains if you're trading in the stock market would be the full-time employment area. Of course, if you see people in full-time employment, that means they have, of course, much more money on hand to be able to buy the goods and services that they want. So if people are taking part-time jobs, there are other factors to consider. Are businesses having to cut back on how many people that they have within their workforce? Or is it simply that people maybe are taking on a part-time job as well as maybe a full-time job as well to supplement their income? If the rates have been raised so quickly and quite high in such a short amount of time, that there is a need to bring in extra cash if they're running out of reserves with their savings. So there's also that factor to consider too. Then if we look at where the economy is at the moment, so inflation So if we're looking at where inflation rate is at 4.4%, which was 0.1% higher than the 4.3% compared to the prior. As said, you had the interest rate decision, okay, where there was a surprise 25 basis point hike that was taken rather than leaving the rate unchanged, which is what most economists had anticipated, until you had the RBA that set precedent on the at the beginning of the week, on the Tuesday night, that they decided to deliver a 25 basis point hike instead, which led to the Bank of Canada, which led to traders believing that the Bank of Canada will do the same thing too, which is where you had Citi, the likes of Morgan Stanley, starting to expect that the Bank of Canada would raise rates by 25 basis points instead, rather than standing pat. If we look at GDP data at 3.1% compared to 0%, GDP month on month flat compared to 0.1%. Employment change last time, so you can see that the jobs amounts, the job amount of jobs is increasing ever so slightly at 41.4k versus 34.7k. The unemployment rate remained unchanged, and the S&P manufacturing PMI with the figure of 49 and the prior of 50.2. So remember, the manufacturing sector of the economy, if with the PMI data, if you have a figure above 50, that usually denotes that the economy is in expansion. A figure below 50 shows that the economy is headed, that part of the economy is headed into a contraction. So that is one other thing to understand, that yes, okay, although albeit there isn't that much difference, that there's still a notable shift, or a slight shift towards the contractionary area, with what we can see where the rest of the economy is at the moment. Remember, this is what the Bank of Canada is looking mostly, most of the figures up, but the Bank of Canada is keeping an eye on. What is the overall health of the economy? What does it look like? Can the central bank go further to raise rates if they believe that the economy can handle it? So again, and what they said when they had paused rates last time around, they repeated their rhetoric that they would wait to see what the effects were on the economy. But then again, you had the RBA that kind of trigger them to go with a 25 basis point hike instead. Triggers then, talking about triggers for the economic release. So we'll go through the deviations in a bit more detail on how the report, how the market reacted to the report last time around. But we can see that according to economists, that they have a high estimate of 50k with a deviation of about 30k. So the median forecast is how we get the deviation. Okay, so the median forecast is about 21.3k, so about 30k deviation there, with a low estimate of minus 7.4k. So again, about a 30k deviation either way. So not really looking at the highs of I'm not really looking at the highs of a 50k deviation of what we had seen in the past of looking at 60. Now it's kind of become a bit tighter, considering how the labour market is also still tight within Canada. The unemployment rate at 5.2% as the highest estimate, with the lowest estimate of for it to remain unchanged. And then if we look at the sentiment views and central bank comments as well. So Bank of Canada, of course, on June 7th, delivering that surprise rate hike, leading to the Canadian money markets seeing near a 50% chance of another hike in July. So what we've got to understand is, again, the Bank of Canada, what they said is that they will continue evaluating whether evolution of excess demand, inflation expectations, wage growth, and corporate pricing behavior are consistent with achieving inflation target. So today's report is, of course, going to be important in the run-up to the next Bank of Canada rate decision that we have. If it is much stronger than expected, let's say there's a bigger deviation than 30k. Let's say we go with a 60k deviation, like we used to do previously with the report, that could influence, not change, the Bank of Canada's view of maybe doing another hike in July, but it could influence to think, okay, the path that they're on of continuing to hike rates is the right path. Maybe not at every meeting, but going off 1 month's bit of data could be enough for them to continue raising rates throughout the year. So if we carry on then, what else we see? So investment bank views. So CIBC sees sees the employment change at 20k with the unemployment rate ticking up to 5.1. Scotiabank sees the employment change at 25k with an unemployment rate of 5%. BMO sees 20k and the unemployment rate remaining at 5.1%. Citi sees the employment change at 40k with the unemployment rate of 5% as well. So this was the last release that we had seen last time around. Now what you'll notice is that we'll go through the deviations too, that there was a 20k or 21k deviation, or 21.5k if you want to be specific, deviation between the employment change forecast and the actual figure. And the market reaction, although there was a form of market reaction, it wasn't as strong as what it was of what we had seen in the past. What we've seen in the past, and we'll go through the deviations, is that when there have been blowout figures from the Canadian data, that's when you start to see a lot of volatility that creeps in and sustained moves from the market. But when the figure is more or less as expected, the release is generally muted. But let's have a little play here with the employment data. So this is, again, as I said, going back on April 6th. Oh, apologies. Sorry, that is the old one there. Let's have a look. Hold on. Apologies. Let me get up the other one. I'll get the deviations up too. We still have plenty of time, so we're about 12 minutes. All right, so here's the reaction that we had last time round. If we have a look, so this is, as said, 10 seconds before the last release that we had back in May. So of course we was paired with the US release as well of the US employment non-farm payrolls data. So you can see that there was when the Canadian data had come out, that the Canadian dollar had actually did see that initial strengthening. Okay, as we can see here on GBP CAD, so we can see that there. Of course, pairing that with non-farm payrolls. Now remember, if you understand market correlations, that when a dollar-denominated currency sees strength, particularly the head honcho, the dollar, the US dollar itself, the other dollar-denominated currencies usually see an appreciation or help in appreciation as well. So that was one of the factors to bear in mind for the Canadian release, is that you also had the non-farm payrolls figure to kind of push the Canadian dollar up in the market. Now it's by itself, the market is going to be reliant on a bigger deviation compared to what we had seen in the past. So one of the other things that had helped the release see an uptick as well. Of course, if I just kind of go back, okay. So also the wage price inflation is also another key factor for traders to be aware of. Of course, that's what the Bank of Canada is when they were referring to that they need to do more work with inflation. That's another thing that is quite key. That of course, if wage price inflation is the same or increases or isn't moving down as quickly as the Bank of Canada wants it to do, then that will lead to the central bank taking a stronger rate hike in the future instead. Homrays Fakar says, how to log in to MACROACE? There isn't a login. You should just be able to, of course, when I send out the email this Sunday, it will be an email that's sent with you like a PDF of the deviations for the economic release. Okay, so let's get out of that there. So let's have a look at the deviations then for the economic release for that day. So here we are. If we bring that here, so the Canadian employment change. So you can see, although the market reaction wasn't that big on the other currency pairs, where you saw the biggest market reaction and consistently with other economic releases from other nations too, with non-farm payrolls, the the Japanese yen has seen the biggest market reactions so far with the majority of economic releases that have come out. Now, of course, you've had today with you've today had comments that the Bank of Japan that they could be, or is still, that they still see the need to continue monetary stimulus, bearing in mind they have their meeting next week to decide monetary policy. But then you also had other points being said, but that the Bank of Japan is said to see little need to tweak the yield curve control in June. Now, when they raised the barrier or for the yield curve control quite a while back, that led to the Japanese yen strengthening in anticipation that the central bank is happier with high yields, and then that would naturally lead to the central bank hiking interest rates as well, and that would push those yields further. But this is the thing, they didn't do that, so the Japanese yen instead had weakened, as it did today this morning. The Japanese yen had weakened as well. Actually, I'll bring it up on the page here for you. Okay, if I kind of scroll down on our feed, on the FinancialJuice feed. So again, FinancialJuice, we chart the data as well. So you can see here that that was the initial reaction that we had seen from the announcement, or from the headline that creeped through, that the Bank of Japan has said to see little need to tweak the yield curve control in June. They need to continue. They still see the need to continue monetary stimulus, and is likely to stick with. And then what happened was, you can see here, the yen dipped further after the Bank of Japan said it's likely to stick with the yield curve control in June. And then Japanese bond futures also gained after Bank of Japan said it's going to stick with yield curve control. So there's that element too. That means that the weakness of the yen could mean that trading CAD JPY, as we've seen in the past, CAD JPY has seen more or less some of the biggest reactions besides GP CAD. Okay, with other economic releases. You've also got to consider how we reacted last time too, compared to GP CAD and some of the other currency pairs. So if you'd seen, so this represents here the initial move. Okay, the initial move on a 1 minute candle, we'd seen 51 pips towards the upside on CAD JPY. Okay, this then figure in the brackets represents the move 10 minutes after the release. Okay, so it was up from the release. It was still up by 52.8 pips from the release. Okay, generally, if you don't see, so if it says 51 and up, and you don't see it saying down in the brackets, it usually means it's moved in the same direction or stayed in the same direction, unless it's specified that it's flipped and it's switched and it's gone in the opposite direction, which is what you'd seen here on dollar CAD. Okay, so bear in mind, of course, you had the US data alongside the Canadian data. Hence, you had seen a messier reaction for the Canadian data on dollar CAD, and you'd seen it flip after about 2 minutes of trading to be two pips down, rather than continuing the trend of going up. All right, so of course, so what we're looking for then, I think, instead of a 30k for decent reaction, I say we would look for a 50k deviation for a decent reaction from the markets, from the report itself, if the economists are looking at about a 30k deviation either side. So that's what we would be looking for as well from our side. So we've got about 3 minutes left to the economic release. Let's get TICKSTRIKE running. So what we're going to do with TICKSTRIKE, because if you're not sure what TICKSTRIKE is, it basically allows you to measure how strong it basically tells you how strong or weak the buying or selling momentum is, okay, via visual and audio alerts. It's a very simple thing, but very effective tool. Again, particularly if you're a day trader, if you're scalping the markets, then but whatever kind of day trading you prefer to do, or system that you use, having TICKSTRIKE part of your system or part of your trading strategy is a very good, useful tool. Again, so this box here is the ticker. Okay, this box. Okay, we've got 1 minute remaining, so we'll talk about the. No, we've got about. Excuse me, I thought I had a 1 minute timer. That's just in my head. So what I was saying was, so TICKSTRIKE. So this box here, the ticker. Okay, let me get my Canadian releases up. It basically, this figure here, if you see 1 or 0, what it does is it tells you how strong the buying or selling momentum is. 1 being that there is a little bit of buying or selling momentum, and 15 showing the extreme amount that there is a lot of volatility, a lot of buying or selling. Okay, so in other words, let's get the rest of the calendar up. Where's my CatGPY gone? There we go. Okay, let's get there here. So we'll be keeping an eye on the CatGPY, dollar CAD, GP CAD. And I think that'll be it for now. Okay. So about less than 30 seconds left. Don't worry, I will give an explanation again about TICKSTRIKE and how that kind of works. Definitely, we're also going to be discussing what the report. We're also going to be discussing maybe why the report has turned out the way it has. Of course, looking at you've got the average hourly earnings too. So if you do see the price tick up in there, okay, minus 17.3k, minus 17.3k, lower than the forecast of 21.3k. So seeing the Canadian dollar weakening here off the back of that data there. Canadian unemployment rate ticked up as well to 5.2%, 5.2%, higher than the forecast of 5.1%. Canadian participation rate at 65.5%, 65.5%, lower than the forecast of 65.63%. The average hourly earnings are 5.1% as expected, remaining flat. So not a blowout figure with the average earnings there, but we can see here Canadian dollar weakening off of the back of that data. And let's measure how big that reaction is. So we got more or less, if we were looking at about we got bigger, we had a bigger amount compared to the deviations of what the economists were looking at. So let's look at CatJPY, because that did have the biggest reaction last time of about 51 pips. towards the upside. So this was smaller, 32.5 pips. Okay, let's look at GP CAD. Don't forget, if you found the information useful, share it with your fellow traders and friends and get the word out there. It's 40.9, so 41 dollar CAD. Let's see what we got. Okay, so you can probably see that there, but charting the data as soon as we can for anyone looking at for anyone who's not, of course, looking at their calendar for the economic release. Okay, that's 28 pips towards the upside. All right, I want to check EuroCAD, see what happened there. Actually, I need to do it in the other window because it would make more sense. Considering we've got the ticker here. So much weaker than expected report from from Canada. Now, what that could mean, okay, whilst if you guys are still listening in to me if you're whilst you're trading, what that could mean for the Bank of Canada is that could change things where maybe traders, the Canadian markets, might decide to not expect a rate hike in the upcoming meeting. There'll be less of a chance that is expected to happen. But it doesn't mean that it doesn't completely put it off. Although the data was quite weak. This is 1 month's bit of data. But so far, a decent reaction from the markets from what we've seen. Better than what we had seen last time around overall for everyone else. So we can see for EuroCAD, yeah, more or less the same. Slightly better reaction than we had on the initial reaction for EuroCAD. So this was 34.5. This was 33.4 pip movement that we'd seen. But CAD GPY didn't have the strongest reaction. If we have a look at the other currencies, let's do AUD and CAD. Okay. That looks to be quite small too. Okay, that was quite small. So I'm going to presume that the New Zealand dollar is not going to see that much action either. Okay, I was again 20.5 pips or 21 pips if you want to round it up. So let's summarize this. Data was worse than expected. Much worse than what the economists were expecting with their low end of their range. Remember, their low end of the range was minus 7.3k, and we got minus 17.3k. And then the unemployment rate also ticked up as well, so that helped the Canadian dollar weaken further. It hasn't reversed, so like it did. Of course, we had non-farm payrolls last time, so dollar CAD isn't seeing that. I believe I've just got to remember if it reversed as quickly as it did, if it's trying to reverse as quickly as it did before. But you don't have that pressure from the US side. If the US had much better data, you don't have that pressure weighing on the Canadian dollar against other currencies. So if we have a look at further as well, as said, the average hourly earnings ticked down to 5.1%, but that was as expected. So there isn't really much wiggle room for the Canadian dollar to try and reclaim some of its losses if the average hourly earnings was much higher than expected. Okay. Okay, so here we go. So what we got here? All right. That basically concludes the release for us today for the Canadian employment change data. I hope you found the information useful. If you did, don't forget to give the video a like, a share, and also subscribe to the channel as well. Now, don't go away just yet if you're going off. We have a lot of important information, a lot of important data coming out next week. CPI from the US, PPI from the US, FOMC, ECB rate decision. Okay, we have key data points that we have that are going to have an influence on what the Fed does, and of course, if the ECB, I'm talking about the Eurozone, if the ECB decides to change their tune or if they decide to keep raising rates as needed from their side. So that is sent in. That information is sent in one email every Monday now. So if you're used to seeing on a Sunday is it's a good rest day, so it's better to put it out on a Monday. I just made that change there. So if you would like to subscribe to the MACROACE mailing list, okay, not only to get the upcoming, not to get the deviations that I've shown you here, right? This, if you're wondering, is it free? Do I have to pay for it? It is completely free. All you've got to do is sign up to the mailing list, and bam, you've got it. It is all yours, and that is a link that I provided for you in the chat there for you. That, again, one email every week on a Monday, just telling you about what to expect for the Asia-Europe session in the US, the upcoming live streams for that week, and with the deviations. It's not filled with charts or graphs or anything like that. It's a short, simple breakdown of what to kind of expect for the week ahead, just to kind of temper your expectations. But again, people love this. People love looking at the deviations, and if they find it useful, then something's working, I guess. But again, this is completely free. There's the deviations for the economic releases, and all you got to do is sign up to the MACROACE mailing list. Going back to FinancialJuice, okay? FinancialJuice, a live voice and text service. So if you never come across a live voice and text service, okay, this is where we keep you up to date with what's going on within the markets, okay? Why the market's moving in the way that they're moving. Maybe gold is seeing a bit of reversal. Why did Bitcoin go down? Because of Binance's issues with Binance and the SEC suing them, right? And also suing Coinbase as well. The pressure that's come through from there. Those sort of bits of news. So we're keeping you up to date with real market news in real time, live in one place at FinancialJuice via voice and text. Also, you have your live economic calendar here on the left-hand side, alongside with the need to know market risks, which represents what traders need to be aware of for the session ahead, or what could be a risk for the markets, or what's already happened that's caused risk within the markets. Okay, if it is such as what we had seen earlier on with the Japanese yen taking a bit of a hit. Okay, how will that affect the rest of the trading session? That is up to you to decide. But of course, we have that information there for you in one place. So if you would like to sign up to FinancialJuice, okay, there is the Pro version, and then there is the Lite version of FinancialJuice. The Lite version has adverts most of the time. It also has advert banners that appear in your text feed. As I said, there's a delay to the voice and text, or actually across the whole site with the delayed version, albeit it's not too delayed, so it doesn't lose its use altogether. That's the free version. The Pro version is not delayed, real time, no adverts. Okay, real time data for your economic calendar here, for the economic calendar here that we have on the left hand side as well. Okay, and you also have access to the news desks, so you can ask questions to the news desk about what's caused the market moves, why is the market moved in a certain way, what to expect for the day ahead, what could be the potential risks for the day ahead. And again, that is the pro version of FinancialJuice. So if you do decide to sign up to the pro version of FinancialJuice, make sure you have an account first, okay, on the FinancialJuice page. Verify it, then go back to your page, and then here it will say Go Pro with a little button. Choose your subscription. Once you've done that, go back to the FinancialJuice page once all the payment is all good, and then log out and then log back in. Okay, and then that will act as a verification process for you, and then you will be able to enjoy the lovely website or the lovely feed that we have of FinancialJuice Pro. Okay. And then TICKSTRIKE, as said, we also have a 7-day free trial of TICKSTRIKE as well. So again, TICKSTRIKE allows you to measure order flow within the market. So not only in Forex, but stocks, futures, crypto, internals, ETFs and ETNs. Okay, that's what it lets you have a measure of. So whenever there's another way to measure is how strong is a buying or selling momentum. Again, if you're a day trader, you're scalping the markets, it's another tool to add to your arsenal. So there is a 7-day free trial of that as well. Although, of course, if you're not used to what TICKSTRIKE is all about, then there is the information about what it is on the link there. And here on the site, there is the free version. But it is restricted to a certain 4 assets. So your stock index, euro, dollar, oil, and Bitcoin. Okay, for the S&P, and then the S&P 500 there. So it's restricted, and it's set at a certain level of sensitivity. So you can't really play around and chop and change it as you'd want to. All right, so that is TICKSTRIKE there, and also unusual activity. So if you like trading high probability stocks, futures, FX, and crypto breakouts in real time, then you can do that with unusual activity here as well. Okay, ladies and gents, thank you very much. Don't forget, sign up to the MACROACE mailing list. I'll be sending out an email at the beginning of the week on Monday. As said, we've got CPI. We used to cover PPI, but we'll be covering CPI, the Fed meeting, and also the ECB rate decision as well. All right, ladies and gents, thank you very much. Enjoy your weekend. Take care and goodbye.